let's just sort of outline the three parts of the presentation that we're going to go through today. The first will be market strategy. We'll remind you of the four key themes for 2026. We covered one of those in our annual market report a few months back, and we're going to focus on the second one today. We'll do a market recap, and the headline there is top stocks were hobbled. And the good news for a lot of investors is that has changed since then, kind of like it did in 2025. And then the final topic will be our market outlook, and the topic there is stagflation, and that's with a question mark. Certainly, that's a word I think a lot of us have heard in the financial media of late, and we're going to break that apart just a little bit so that you can understand what it means if you're younger. If you're older, you probably lived through it, and perhaps the signals to watch out for if we're headed in that direction. So just as a reminder, at the beginning of the year, we talked about the potential revaluing of debt and currencies. Certainly the dollar has fallen in value. We're looking at credit spreads and interest rate risk, even as that might apply to treasuries. We're going to focus on shifting global trade power and how the U.S. is being isolated a little bit later on in this presentation. Later in the year, we're going to talk about some fun ways to use math to your advantage. I promise that's going to be kind of entertaining when we get to that. I'm looking forward to that. And then as we round out the year in the final quarter, we're going to talk more about maneuvering for the post-Trump era. When I say the countdown clock is ticking, of course, we know we have a lame duck president, which hasn't slowed him down at all. But the midterm elections are coming up, and that could change the political power structure in Washington significantly. But there's still a lot of time between now and then, and we'll have more data to put into our equations when we get closer to that time. So just the headlines for our market recap. Again, the top stocks were hobbled. And let's start by taking a look at the top 10 stocks in the U.S. stock market. Now, some of you know that the U.S. is a big part of the global stock market, but within the U.S., these top 10 stocks are now about 40% of the total. They were 35%. We began worrying about this at the beginning of 2025, and boy, the Q1 returns in 2025 were pretty devastating for these top stocks, even though the global equity index was only down a little. And then if you blinked, you might have missed that bad news, because the good news came pouring in and those stocks rallied hard later in 2025. We did another price earnings ratio analysis at the beginning of 2026, became very worried again. And then what happened in the first quarter of 2026? Those stocks got hammered again. Well, guess what's been happening since the end of March? Those stocks, for the most part, are rallying again. So what happened in 2025 is turning out to be really, I guess you could say, the template for what's happening in 2026. High valuations with those top 10 stocks, big sell-off in the first quarter, and then a rally to begin to bring most of those back. So again, just following almost perfectly in the footsteps of 2025. We'll see how long that progresses for the rest of 2026. If we look at the benchmarks that were also published on your quarterly portfolio report for the first quarter, again, if you're diversified, you might not have noticed the big tech sell-off, but the global equity index was down 2.75% for the quarter. Fixed income was more or less flat. If you want to see some more encouraging data, you can just look at the 1-year numbers. But frankly, the 3, the 5, and the 10-year numbers are really, really terrific for equities. That is in opposition to what you've seen in fixed income. It's been a while now, but some of you may remember that in 2022, the fixed income index was down over 13%. So some real volatility in fixed income when rates get too low and then suddenly rise due to inflationary pressures, such as we might be facing now. We'll get into that. But there's another observation that I want to make about this slide. If you're nearing retirement, in retirement, or just worried about the stock market, you might be seeking safety in fixed income. And, the 1 year return of 4.35% is not too bad. There's a lot of work that we're doing in fixed income, in particular in private fixed income, to try to give us some better opportunities than this benchmark would reveal. But if you need money withdrawn from your account in the short run, safety comes from fixed income and risk comes from equities. But if you think long term, if you think 10 years or more than 10 years, for many of you listening to this, you might be looking at 30, 40, or 50-year time horizons. Actually, the risk comes from being too much in fixed income, and the safety comes from being vested in the equity markets, sticking to your financial plan, buying on the dips, doing those types of things. So again, short run is the way we tend to think, most of us. Safety's in fixed income and risk is in equities. But if you think over the very long run, and this is certainly illustrated over the last decade, significant returns from staying invested in equities, and 11% a year compounded over a decade gets you a nice multiple of what you started with. So the short term and the long term have very different perspectives in terms of mathematically what is safe and what is risky. We've observed a phenomenon for a number of quarters in the last 18 months, and again in the first quarter of 2026, and that is that the U.S. has not been the best place to invest. Now, we have a modest overweight to the U.S. We always have. Most advisory firms do in the U.S., most investors do in the U.S., some only invest in the U.S. But what we see here is a depiction of the returns from different investable economies all around the world. The global average is that downwards blue bar in the middle, that's down 2.75%. And then you see the US depicted in green. We were down a bit more. And so the US and the global average might never be too far apart because the US is nearly 2/3 of that global average. So a lot of overlap in the data there. But we've consistently seen the US coming in below the global average, as the best places to invest have been overseas and actually in emerging markets for the first time in a while. Breaking down the US markets in the first quarter, we saw returns that are somewhat consistent with what we've seen over the very long term. If you look back at the last 100 years of market data, or just about any 15 or 20-year period, value stocks have done better than growth stocks. Small companies have returned better than large companies. That's definitely what we saw in the first quarter of 2026 in the US. Overseas and developed markets, the story is really the same. The returns came from value stocks, which did way better than growth, and then to some degree, small stocks doing better than large stocks. That's been a more consistent trend overseas in the last decade than it has within the US. And part of that is because these biggest companies, these large tech companies, these hyperscalers in the AI world, don't exist really outside of the US, or at least not nearly to the same degree. And that has led to this outperformance of growth, depending on the quarter, over this last decade. But across the globe, value stocks have been great performers. And again, small cap stocks have tended to do a little bit better than large cap stocks in many quarters. In emerging markets, we get to see these terrific looking numbers here. And the story, of course, is the same. Value outperforming growth, although large and small more or less returned the same. But emerging markets in total, regardless of how you slice it up, have had a great year, and that has led to some fantastic 3-year returns as well. So not a bad quarter outperforming the US, but a fantastic year. And as this recovery has taken place in the second quarter so far, emerging market stocks have really led the way. Talking about fixed income for a minute, and I've got a feeling we're going to be talking about fixed income a lot more. There's just a few things to take away from this slide. Now, the first is going to be that top middle portion. And what I really want to point out is this: that is almost a normal looking yield curve. And when I say a normal curve, that's what a lot of us learned in business school. Short-term rates should be lower, long-term rates should be higher, and that's called a normal yield curve. What we've seen for so many quarters over the last few decades has been that short-term rates might be higher, or short-term rates might also have this severe distortion at the very short-term end of the curve, which really just means that the Federal Reserve is either a bit ahead or behind where the markets are. When you don't see a big upturn or downturn at the short end of the curve, what it really just means is the Fed is probably doing its job pretty well. So what we've seen over the last year and just a little bit of late is that some questions are emerging about what the Fed is going to do. If you can look through this graph for the end of March data, what you'll see is a pretty normal looking curve without distortions on the short end, suggesting that actually the Fed's posture right now is exactly what the market wants to see, and the market's not anticipating that anything needs to change anytime soon. So that's kind of nice to see. It makes it a little bit easier for us to invest in fixed income when we don't have these severe distortions. Another thing to take away from this slide might just be what you see in green in the rows below. We're really breaking apart the fixed income market into a number of different pieces, and we don't tend to index fixed income. Again, there's a lot of risk in the fixed income index that has shown up of late, but there are parts of fixed income where we can invest pretty safely, and that's what we've tended to focus on because our priority in public fixed income is capital preservation. There's other more exciting things that we may do in private credit, and there's safer things and more adventurous things there. But for the public market side, capital preservation is really our priority. Now let's look into the future while looking into the past a little bit. If somebody's been investing for decades, they're going to be familiar with this term. Or even if you were going to the grocery store in the 70s and 80s, when you can remember, milk was just more expensive every week. Eggs were more expensive every week. A loaf of bread was more expensive every week. Stagflation can be a terrible thing. And that's just when inflation is high, but the economy is not growing fast enough to keep up. So let's first talk about one of the key themes for 2026, and that's the shifting global trade power. Now, we mentioned that as a key theme, and we're giving you a few details here. We could really spend an hour going through all of these different trade agreements and what they mean. But here are just three examples of trade agreements that are either new or have been significantly updated so far in 2026 that are designed to do one thing, and that's exclude the United States. I do remember when we were coming out of COVID and so many supply chains were hamstrung by Chinese government policies, right? They had a zero tolerance policy. Supply chains were in trouble. Inflation was exploding because of it. And across the globe, economies and individual companies began figuring out how they could exclude China from their operations, how they could get rid of that volatility. They were having a hard time predicting what policy could be. It's kind of similar to that right now. The EU is leading the way, but in agreements with India, Latin America, but even Japan and Canada and Australia, there are efforts being made to sign agreements, create stability for the long run, reduce or eliminate tariffs, and chart a course into the future that is not affected by the volatility of U.S. economic policy. So that's not necessarily an indictment of U.S. economic policy. A lot of the efforts have been motivated by an attempt to cure some, I'll call it past mistakes that have cost the middle class their jobs and things like that. But this is not a static environment where only one party is making moves. All parties are making moves to protect what they perceive as their own best interest. And the net effect of that could be that the United States is just becoming more and more isolated. Now, the reason that that's listed under the topic of stagflation is that can lead to lower levels of economic growth and inflation, both of which are the key components there of a potential stagflationary environment. Part of the stagflation equation, of course, is how fast is the economy growing. And one of the most frustrating things for anyone doing economic analysis is this effort to get accurate numbers for our GDP. Now, sometimes I'll show GDP, but as regular watchers of this webinar and the in-person quarterly market reports will know, when GDP numbers come out, we don't pay that much attention to them because we know that there's going to be 3 revisions. And so by the time we think we really know what's an accurate GDP number for a particular quarter, we're really a year down the road. And so it's not that helpful as a tool to forecast the future. One of the best tools out there, although it is very volatile and very imperfect, is run by the Federal Reserve Bank here in Atlanta. And they have a number called GDP Now. And if you glance at the dates on the horizontal axis there, what you'll see is sometimes this gets updated daily as new data comes in, and it comes in from a variety of sources. They try to update what they think real GDP will be for the next year. Now, when we talk about GDP, we're usually talking about real GDP. Real GDP doesn't mean, oh, just the legitimate number. It means what we'll call nominal GDP reduced for the impacts of inflation. So if the economy is growing at 4%, but inflation's at 3, the real GDP was closer to 1. And so this is forecasting real GDP. 1.24% was the number as of 3 weeks into April, but that has since gone up, and it's more about the 3.5% range right now, but that rises and falls daily. So the price for real-time forecasting is this volatility of the forecast. So it's interesting to look at. It's always informative. Every piece of data helps, but we're either stuck with looking at correct numbers that are a year old or a forecast that changes potentially daily. So again, we're sort of starved for data on how is the economy doing, but that's just the way it is. Inflation is less reliable. Inflation data, I'll say, is less reliable than it's been in the past in terms of where we're at the moment. But there are some lessons from the past, once this gets finally corrected, that are very, very important to hear. And so here's a chart going back into the into the stagflationary times of my childhood and for many of our listeners. And we're graphing several things here. First of all, notice the vertical gray bars. Every vertical gray bar is a recession. And so we know that's when nominal economic growth went negative. But the lines that you see enhance that story a little bit. We're depicting inflation in 2 different ways here. We're depicting the headline number, which is CPI, in this case, CPI U, which is for urban consumers, but think of it as the CPI for you, the total number. Now, that includes energy, that includes food, that includes some really volatile things that change rapidly. There is another number in here, and that's the blue line there, and it's called sticky inflation. So sticky inflation is a real economic term, and that just means that it tends to be a little less volatile, it tends to be a little bit more stable. Although when you look at the depiction here, it doesn't necessarily look that much more volatile. You'll see usually the CPI is leading changes in the sticky inflation. What you really ought to take away from this, though, is that every time there is a spike in inflation by either measure, usually concurrently, you see we end up in a recession. And so you can go back to the early 1970s, inflation spikes, we're end up in a recession. And the real GDP, that's the dotted orange line, goes negative, meaning that inflation was ahead of economic growth, and that's really bad for consumers. And so you can just follow that through the last 5 decades. Inflation spikes in a recession, inflation spikes in a recession, with one exception. We did see inflation spike post-COVID. Part of that was China's fault. Part of that, I think, was our own Federal Reserve's fault for keeping interest rates too low for too long, because that tends to make inflation worse. And so we spent here at BIP, well, 3 or 4 years telling our clients that we didn't think we were going to have a recession, and we didn't. But that's really been the one exception over the last 5 decades. And again, one that most economists got wrong, but we did get right. So if you start to see inflation spike here in the near term, most of the time that means we're going to have a recession. So how's inflation doing? Well, you'll notice the big gap in data there. And what I'll say is that while there was a gap that's been restored, thanks to the government shutdown, the ability to get accurate measures for where we're at right now has actually been reduced. Again, another frustrating thing for someone that lives off of data, and that's because people don't respond to surveys the way they used to. The government agencies that are responsible for collecting this data have become a bit underfunded. And so we have less confidence in the inflation number. Nevertheless, it does look like it's been picking up. And so if that turns out to be the number where we're at a bit of a local high, as you might say, over the last couple of years. So if inflation gets worse from here, and I think it might, we're coming off of a local high, and who knows, maybe we're going to see this get into the 4 to 5% range. If it gets high enough, probably going to lead to a recession. So we've talked about all of the measures. Let's look into the future, talk about why inflation might be about to spike. Well, the most obvious thing to look at is what's going on in the energy markets, but really the entirety of the commodity markets. And so here's the biggest commodities. And of course, if you look at the gain in just a short period of time, what you see is that energy prices are leading the way. And so you see oil, gas, and then a few other things like soybean oil and Kansas wheat are following behind. There's a lot of those other commodities that have energy as an input to them. You can't harvest crops without spending energy. You can't transport crops without spending energy. And so some of these things tend to be correlated. But just in the last quarter, the Bloomberg Commodity Index is up 24.41%. Now, you can't really invest in the spot prices. You have to invest in futures. That's a different matter. Otherwise, we might have pivoted to an investment allocation here. But this tends to be a somewhat reliable input into how inflation might go up or go down in the future. And this kind of sudden surge tends to suggest that we're going to be under some inflationary pressure in the remaining quarters of 2026. Now, we talked about energy prices, but I do want to spotlight something in particular that's out there, really just to try to correct some, I'll call it misreporting in the financial media. There is this concept in energy of the data you can easily access every day, but that's what we call futures prices. If you go into CNBC or other data services and you look at what did commodities do today, what you're often seeing, you might notice, is June delivery or July delivery. Those are futures prices. In fact, when refineries are refining their oil to a variety of distilled products, they've often locked in their selling price using those futures. But refineries have to buy oil on the spot market. And so when there's a spike in the price on the spot market, it can often be quite separated from what's going on in the futures market. And at the beginning of April, we saw the spot price for Brent oil, West Texas Intermediate oil, other oil producers around the world. We saw the spot price for that jump considerably. So the average spot price for Brent was 127 at a time when the futures price was about $30 lower. And that's just the average for the spot price. There were places around the world where refineries were paying $150 a barrel, even $175 a barrel in isolated instances. So the spot price and the futures price are different. And we did go through a period of time, frankly, when refineries we're losing $5 or $10 a barrel from buying on the spot market and refining product and selling at prices they had locked in through the futures market. So the energy markets are more complicated than we tend to think. And it's this spike in the spot market, even more than the futures market, that is putting some of the inflationary pressure out there. It's also worth mentioning that the last ship to get through the Strait of Hormuz before it was initially closed landed in port about 2 weeks ago to begin offloading its cargo. So even if the Strait of Hormuz were open today, it'll be a month or two before those ships transiting will find their final destination and unload their oil. So there's another element to this that I'm not depicting here, and that's what's happening with supplies. So reserves are being drawn down, and that's a complicated market as well. You have total reserves, and then you have what's at the bottom of the barrel. A lot of oil in storage needs some processing. You have a lot of sediment settle and things like that. So it gets very complicated. In the U.S., we actually have enough oil. We're a pretty big energy producer here. The problem is really that we have tankers lined up in the Gulf for us to sell a lot of that oil, and so that pressure to buy coming from other countries tends to drive up our prices, even though we're a big producer as well. So just being a producer, even of the scale that could, in theory, meet our own needs, doesn't necessarily help that much when we're part of a global market and we are in fact exporting a lot of that oil. Now, I want to offer another perspective here with a nice chart that somebody else authored going back more than 5 decades, and really we could have this chart going back 100 years. The lesson here seems pretty simple, but it's really just worth reminding ourselves of, and that is that with the benefit of time, we can look back and see that the stock market has managed to get through a very large number of crises that at the time almost seemed like economy ending crises. I certainly remember trying to drive to the beach with my family when I was a kid and seeing, the price of gasoline just go up to just unbelievable at the time numbers. But we've been through so many different crises here, whether it was Hurricane Katrina or the savings and loan crisis. There's just been so many. So far, our available data set tells us this, and that is that capitalism and democracy figure out a way. It's my belief that capitalism is an inherent human tendency. Even in illegal black markets, you have capitalists of a sort out there uh, pursuing their own goals. And so, we can discuss what's proper regulation, and you need contract law and property rights and all these things. But so far, capitalism being driven by innovation, being driven by entrepreneurialism, and now happening in a world of AI, has, at least according to the data that we've got, always grown the global economy, usually grown the American economy, and always led to success for investors that can stick with their plan. And again, to go back to the lesson that I mentioned before, fixed income is a great way to reduce risk in the short run, but being allocated to the safest assets sitting in cash is usually a real risk for people over the long run. Over the long run, safety comes from being invested in the stock market, letting your assets grow, not selling out, but in fact buying on the dips, taking some profits on the peaks is a big part of that as well. Certainly something that we've been doing for a lot of clients over the last 3 to 4 years. So that's the lesson there. Again, I didn't write this article, but I thought it was a pretty good article to point some of those things out. Moving on to our final thoughts here. Again, just to repeat a few things. Let's just remember this. Global trade power is shifting, and we're going to probably read some scary headlines, but the future is never quite the same as the past. Um, the European Union is really leading the way with these new trade agreements, but the world is changing, and there's a little bit of might makes right philosophy overcoming the global economy, a little bit less of a sense that there is a shared interest that democratic and capitalist economies share, really with that being led by the U.S. So the data is going to be different. What we can make of the data is going to be different. We do know that the future will be different. Economic growth and inflation conditions might be deteriorating. One of the best ways to figure out if inflation is coming our way is to look at interest rates. And so, one of the first things I'll look at every morning is what's the 30-year Treasury rate? What's the 10-year Treasury rate? Are those things moving? Now, we're going to complicate that with a little bit that I think, in about a week, are going to have a new chair of the Federal Reserve, and there's the thought that he might lower short-term interest rates. Certainly, that's the call by the White House. But in an environment where we might already be faced with inflation, not from an overheated economy, but from threats to the supply chain in terms of energy, lowering interest rates might create more inflation. Maybe it's what's necessary to spur economic growth. There's going to be some really hard decisions being made there. At the same time, we're looking at economic growth, and earnings are looking pretty good in much of corporate America, but AI is changing everything. We've got the hyperscalers borrowing vast sums of money. The amount of debt in the markets is exploding as many of the hyperscalers building out their AI data centers are borrowing money to do it. So that's driving a degree of economic growth. It's not the only source of that, but it's a new phenomenon for sure. And it's certainly driving up energy costs at a time when energy costs are already high because of the conflicts in the Middle East. So you could see the right combination of events manifesting where economic growth takes a hit and inflation spikes up, and that would indeed be that stagflation. We're not predicting that just yet. We're starved for enough of the relevant data that we're not ready to make that call, but we're certainly watching out for it. And again, just as a reminder, current events are unsettling, but you know what? Current events are usually unsettling. Some of the few times in my investing career when I felt pretty happy about all the data, everything looked great. That was followed by a big downturn in the market. So, really, let's remember that it's pretty normal when you're an investor in the stock market to be a bit unsettled. Sometimes I say it's like standing on the edge of a cliff and waiting for a gust of wind that might blow you over. That's kind of a normal thing, but we're all going to do our best to frame those emotions and those thoughts in the long-term confidence that democracy, capitalism, property rights, rule of law, and just the innovative spirit of millions and millions of human beings will cause us to be rewarded in our faith in the stock market in the long run.
Nice job, Eric. Let's go to questions. This is a really good one. The first question, Eric, is from Quentin. And Quentin says, for several market reports, you've mentioned BIP's growth. How will you maintain quality and ethical considerations in the forefront of what you do? Frankly, this rapid growth makes me nervous. It's a really good question because we do keep talking about growth. So happy to let you take a stab at that, Eric, and maybe add any color to that.
Believe you me, this is something that we talk about and focus on internally every day. One of the things that we're predicting, and we've been watching for this for decades, and it hasn't happened, but we're predicting now, is that we're operating in an industry that is likely to undergo some big waves of consolidation. That's already started, and there are very good reasons for that. Clients of BIP Wealth, I hope, have become accustomed to the idea of high integrity, high quality. But I won't say that that's necessarily the norm across the industry. I think there's a lot of good people working as registered investment advisors, but it takes a lot of resources and a lot of dedication to make sure that you're doing a good job in all those ways that you as a client and investor would want. And the amount of resources necessary to do that in the age of AI are growing. I like to think about a potential future as a test of how we're doing our job, where you wake up in the morning and, in my example, somebody decides they want to buy a boat and they ask their AI agent, "Hey, I want to buy a boat. Should I do that?" And the AI agent, teaches them about all the different kinds of boats, and are you going to be taking this to the coast? Are you going to be up on Lake Lanier? Where are you going to be? Walks them through that, and then starts to talk about the cost and the money. And at some point, is asking, "Can you afford to do this?" And you're wanting to know the answer, and your AI agent says, "Well, let's go ask your advisor at BIP Wealth." Of course, your AI agent is talking to the AI agent at BIP Wealth. It gives you some initial answers because you have goals and things that say, yes, you can, or maybe no, you can't, or this merits further discussion. Your advisor is available to talk to you at 10 o'clock this morning. Can I schedule a 45-minute meeting with your advisor to put some real hard numbers to this and compare this to how it fits in with your other financial goals? And at 10:30, you're talking to your advisor about this and pulling in all the data. Now, that's not something we can do right now, although you're pretty close to being able to do that if you have the right AI agent. But we need to be able to respond to that. We need the resources, the scale to be able to do that for you. So in this world that's changing, and let me tell you, the investment landscape is changing, right? Things we can do in private markets, BDCs, interval funds, that's changing rapidly. We need scale, we need resources to be able to be the best that we can be. In keeping up with that or getting ahead of that, we need the resources to be the best that we can be, to make sure that you can interact with us in all the ways that you need to in the world of AI. And we need to be able to get you better answers quicker than ever before because that bar is being raised. So it's a great question to ask. It's one we ask as well. But we feel like this growth is really the mechanism for us to be able to have the resources, financial and talent, human talent, otherwise, to be able to respond to this new world we're entering and to give you the quality of advice, the quality of investment selection, and to monitor the ethics. Your advisor is, we do everything we can with compensation arrangements to make sure that there's minimal conflicts of interest so that their only interest is in giving you the best advice. But sometimes you got to monitor those things as well. And frankly, scale and AI help us to do that too.
It's well said, Eric. And I would add, Quentin, that it's certainly not growth for growth's sake, that we're being very deliberate with the partnerships that we're considering. And you can probably imagine that partnering with other great firms with great teams is a bit of a forcing function for us. Eric sort of alluded to it, but teams that have not just done it the way that BIP has for the last 17 or 18 years, but have some of their own methods, certainly share our values, but those teams are really, I think, burnishing us and forcing us to ask tough questions about why we do certain things and how we do certain things. And, here's some things that we offer to our clients. Why doesn't BIP do that? And then vice versa. So I really think there's certainly value in having homogeneous ethics and morality, but there's lots of value in having a bit more heterogeneous or a heterogeneous approach to processes and products in some cases. So we see this as a really good thing as we expand. That it's really challenging some of the ways that we do business, and I think ultimately making us better. That's a really great question. Eric, while we maybe wait for one or two more questions, you've done now several of these over the past couple of weeks. Certainly, the farther you get down the road, the more life happens, and there's headlines and there's the news cycle. But if you're willing, might you share one of the more challenging questions you've received from some of the other QMRs that you've run? I imagine there's been some really good questions.
Well, Nate, without a doubt, the toughest question that I ever get is one that asks me to opine on the future of the scale of our rapidly growing national debt. I've mentioned many times in the past that there's some online simulators whereby somebody like myself or anyone on this call can go in and play with the numbers in attempt to solve a problem with national debt. And it's always, tempting to just say, let's raise taxes. I'll let you know right now that the size of our national debt approaching $40 trillion is about the same as the value of our annual GDP as a country. Um, and that's a scary threshold to cross, kind of a magical number that is scary to see. But if we go in and raise taxes and we cut government spending in these simulators, at least the first thing that happens is that we plunge into a severe recession, and that ultimately reduces tax revenues. We probably have had an opportunity many times over the last decade to raise taxes a little bit in a smart way, cut spending in a smart way, and that's just not what politicians get elected to do. So now here we are. It's a little frustrating to not have any lessons in history to draw from where we've been in such a nominally bad situation. Uh, but we're kind of all in this for the first time. So that's a really tough question. What's the future there? One thing that I do look at, though, is a bit of a guidepost, is the fact that our government can still raise treasury money for 30 years, the 30-year treasury bond at less than 5% per year interest. The market seems to know something. There's an old saying that the bond market is the smartest market, right? The stock market can get overvalued, undervalued, and sort of get led astray at times, leading to severe corrections. But the bond market is generally the smart market. So if there's trillions of dollars that are being lent to the federal government for 30 years at less than 5%, what does the market know that we're not thinking about? And of course, the great hope for that is that we're going to grow our way out of this problem. And AI may very well be the key to doing that. Now, we're still going to have to make smart decisions. Many taxes might be a little bit too low. And spending fraud, waste, and abuse and other things need some really hard kind of bipartisan looks to deal with that. So if we get the growth from AI and we can you know not give away too much in taxes where it makes sense, and cut some spending where it makes sense, and maybe increase some spending in other places, right? You got to do all of this the right way. Maybe we're going to be fine with regard to national debt. So that's probably the really big one, and I hope those answers that I threw out there are helpful enough. But we're all kind of guessing because we've never been here before.
That concludes our presentation.
Yeah, and we got to thank you, and I appreciate that for the folks that sent that in. And yes, thank you to everybody for tuning in, and we enjoy doing this too. Take care.